markets opened on September 24, 2025 in a cautious mood as investors digested fresh remarks from Federal Reserve Chair Jerome Powell suggesting that U.S. equities look richly valued. The comment nudged rate-sensitive growth names lower and kept intraday volatility elevated, while the Dow held up better on a mild rotation into defensives and cash flow quality. The backdrop is the same tug-of-war we have seen for months: sticky services inflation, a still resilient labor market, and a Fed that prefers to see more evidence before cutting policy rates, which keeps the discount rate narrative front and center and forces a reality check on lofty forward multiples. Across big tech, one pocket that showed relative strength was defense. European contractors gained after headlines tied to support for Ukraine filtered through the tape. And that tone tends to spill over into U.S. primes such as Lockheed, Martin and RTX. The fundamental story there remains multi-year in nature, built on NATO rearmament, replenishment of munitions, long contract cycles, and robust backlogs. The risk, however, is obvious. Policy and headline sensitivity can amplify short-term swings. So traders treat pops with respect, while longer-term holders focus on guidance cadence, awards, and execution. The other major theme of the day sat squarely in artificial intelligence. Alibaba rallied as the company pushed forward with a new flagship language model positioned at the trillion-parameter class and reiterated a larger commitment to AI infrastructure investment. For investors, the raw parameter count matters less than the capability curve. Inference efficiency and attach economics into the company's cloud, commerce, and developer ecosystems. If its agentic and multimodal stack matures and finds product-market fit in enterprise and edge scenarios, a valuation re-rate becomes easier to justify. The flip side is the persistent overhang from China's macro, regulatory complexity, and U.S. export controls, which can compress multiples quickly when sentiment cools. Crypto's institutional rails also grabbed a headline as a Solana-focused company began trading on Nasdaq under the ticker stake. This is not a comment on token prices as much as it is another incremental step in compliance, custody, and listed vehicle availability that traditional mandates can actually touch. Each approved structure, audit milestone, and exchange listing makes it structurally simpler for pensions, endowments, and multi-asset funds to allocate in a controlled way. As always, liquidity cycles cut both ways, so participation does not immunize anyone from volatility. Across sectors, the market continues to treat AI platform leaders like Nvidia and Microsoft as the core beneficiaries of compute demand and software monetization. Yet they are also the most exposed to rate shocks, because a meaningful share of their value sits far in the future. When real yields drift higher, or the market reduces the probability of near-term cuts, duration assets feel it first. Financials such as Morgan remain a study in curve dynamics, a later but ultimately delivered easing path that steepens the curve can stabilize net interest margins. But the credit cycle into 2026 still matters. With commercial real estate and consumer delinquencies on every risk manager's dashboard, energy splits into two clear narratives. On one side, integrated oils like ExxonMobil benefit from capital discipline, buybacks, and free cash flow resilience through commodity swings. On the other, long-duration renewables proxies such as NextEra Energy are sensitive to financing costs, policy support, and grid-scale execution. But they also sit on the right side of the structural transition story. None of this erases the risks board. If disinflation stalls, Powell's careful tone on valuations will keep pressure on multiples, especially for long-duration growth. Geopolitical news can rapidly reprice defense both directions in a single session. China tech exposure remains tied to policy and cross-border controls, no matter how exciting the AI roadmap appears on slide decks. Crypto-adjacent listings expand access but cannot remove the cyclicality and reflexivity that define the asset class. Position sizing and time horizon become the only real shock absorbers. Into the next sessions, the focus turns to the usual catalysts, additional Fed speakers for hints on reaction functions, Treasury auctions for term premium color, and the next inflation prints that could confirm or challenge the softening narrative. Earnings and guidance matter as well, particularly any commentary on AI capital expenditure from hyperscalers, on defense order, timing and supply chains, on bank credit quality and funding costs, and on energy capital returns. The working watch list reflects those cross-currents. Defense names ride multi-year procurement, but carry policy headline risk. Alibaba represents AI upside against China macro and regulatory uncertainty. Nvidia and Microsoft remain the AI core with valuation sensitivity to rates. Morgan is a curve and credit barometer. ExxonMobil and NextEra energy straddle the energy complex from hydrocarbons to renewables, giving a clean read on commodity leverage versus long-duration project math. For investors and creators alike, the playbook has not changed. Anchor every take in the relationship between rates and valuations, separate durable themes from headline noise, and pair enthusiasm for innovation with a sober view of execution risk and capital intensity. Markets reward clarity, cash flow, and timelines that actually arrive. Keep your thesis tight, your sources visible, and your risk budget honest.